Hello, everyone. Hope everyone is well. It's our next episode of Lumida Non-Consensus Investing. It's Friday, 2 p.m. Eastern Time. I'll be at Money 2020 this Sunday through Wednesday of next week. So if you're around, let me know. I've got a lot of time Sunday afternoon where I'm not booked, but I'm looking forward to being there. It really is the epicenter of where payments technology converges. So I'll be doing a few live streams there. So holler out if you are there. Been busy, been a lot of travel the last few weeks. We were in Puerto Rico looking at some of the opportunities in that market, and was attending a few conferences in New York this week. And maybe you saw my live streams or not, but the main headline I would say is that people are overly pessimistic and sidelined. And it's palpable. It's very palpable. I was in an alternative investments conference. I was on a panel, and they asked everyone for their best idea. And there's 4 people, and persons 1, 2, and 3 said private credit. And I said, actually, you shouldn't necessarily be focused on alternatives. Why don't you own equities? Earnings growth is going up. You have a pattern of disinflation. Earnings growth is strong. Productivity growth. The best you get in private credit is you get your principal back and a rate of return that's set in a competitive market. People are, I think people aren't recognizing reality for what it is, which is that this is Goldilocks. This is a Goldilocks setup. It doesn't feel like Goldilocks because of news and headlines around mayors and what's happening with the East Wing, and some geopolitical risk. Is there going to be another trade war with China or not? No, there won't. Is there going to be a reduction in geopolitical risk in Russia? Who knows, but doesn't matter. And so, the best Goldilocks is the Goldilocks that doesn't feel like Goldilocks. That's actually the best kind of Goldilocks. Because the Goldilocks that feels like Goldilocks is fully priced. That's the Goldilocks where you're fully valued and everything is in a state where you really don't want to disturb the system. That's when you have the most kind of risk, actually. So I find myself in the funny position of being a non-consensus bull defending artificial intelligence. I mean, who would think that would be happening now, right? This just sounds crazy, right? Even Andre Karpathy is pessimistic on the onset of AGI. He says 10 years. I don't think that's even the relevant question. It doesn't matter when AGI arrives. What matters is the rate at which AI can seep into the real economy and drive productivity growth. And operationally comes down to the rate at which you can amplify an individual or team's productivity. And what you're seeing is tremendous improvement, initially in coding and now in other areas. There's an individual whose daughter was diagnosed with cancer by AI. They had a timely intervention and saved her life. That's real impact, right? And you're seeing it in the banking sector. You add to that the innovation around payments with the rise of stablecoins. It's a pretty exciting time to be alive and be a part of all this transformation that's taking place. So, message number 1 is don't be gloomy and doomy. Don't be gloomy and doomy. I'll let you know to the best of my ability when that should happen. It's not now. It's not now. There was a moment 2 weeks ago where things didn't look quite stable. Things looked overextended. And then Friday, we had this kind of one-day rinse. There was a trade war spat with China. Markets went down 3.5%. Trump talked over the weekend, and I was like, all right, we're back now. That's it. And that's what I see happening. You have these buildup of these temporary excesses, and people have a lot of fear. These one-day rinses, and you're back. And I don't see why that wouldn't keep happening, especially with the exceptional earnings growth that we're seeing, which is ahead of what analysts' expectations are. And this is what I've been writing about in the Lumida Ledger newsletter. I hope you're reading that. I'll highlight some of the key takeaways from that. But honestly, it would take me 2 hours probably to go through all of it. But I'll highlight, to go through it in depth at least. You can read it maybe in 20 minutes. This last one is called Bank Earnings, a Cheat Code to the Economy. And the main headline is that the economy is still strong. And what we do is my team goes through their earnings transcripts of companies that report by each week, by each day. We look at what they're saying and the alphas in the transcripts. And you can see bank earnings are much higher, deal flow is back, credit is extending and increasing. The American consumer is still spending. This is what Bank of America CEO Brian Moynihan had to say, quote, debt and credit spending are up mid-single digits. We continue to see steady outflows for travel, entertainment, and dining, while goods spending has moderated. Well, people have been shifting to services away from goods for a long time, right? Services include things like your Netflix subscription, Amazon Prime. People have their merchandise. People don't need more furniture. They have that. So, but this continues. People are focusing on experiences. Here's Brendan Coughlin, head of Citizens Financial Group, president or an investor in that business. He said, quote, inside of each category, delinquencies are very stable. I broadly characterize it as a fully normalized from COVID. You have to really de-average it to see stress. It's concentrated at the lower end of the market, which we typically don't serve. So he's saying things are very stable. There's stress in the low end of the market. The low end of the market is not the economy. It's not relevant. I'm not trying to dismiss the stress that people face. From an investor perspective, from a market's perspective, it's not terribly relevant. Okay. The AI productivity cycle. So fun story. I had dinner last night. My friend Robert Dewey, ex-Morgan Stanley guy, invited me, and there were 8 of us around this table. And I shared this anecdote that Amazon is shedding 600,000 jobs and replacing them with robots. And I was corrected by a number of people in the audience. They said, oh, well, no, I think you mean 6,000. Oh, 60,000. I thought I was wrong. I was like, shoot, maybe I just misread it. It's late. It's 8:30 p.m. I don't know. Then I said, let me just check anyway. Let's check my phone. Like, maybe I'm wrong, but what is the actual number? So I look it up, and yeah, in fact, it says Amazon's going to lay off 600,000 jobs, replace them with robots. I share that with them. And this is called cognitive dissonance. People aren't seeing reality. The incoming data isn't updating their beliefs around the world. That creates a dissonance. So they're dismissing evidence. They're dismissing this evidence. And that makes me even more excited when I see that. You combine that with this backdrop of this malaise that's in the air. People feel this malaise. A big chunk of that's politics. Right? If you ask someone what their political preference is, I can tell you what their view of the economy is. This is a modern phenomenon. Okay? That's one. Number 2, maybe seasonal affective disorder. But it really shouldn't be. The data we're seeing is strong, just beating expectations. So here's a stat around AI. So Goldman Sachs might like to make fun of. They predict hyperscaler capex will reach 1.4 trillion cumulatively from 25 through 2027. They're predicting spending of 471 billion next year, before rising to 543 billion in 2027. Okay, those are big numbers, and they're growing, and they're being funded by the biggest hyperscalers in the world and governments, and increasingly defense contractors and sovereign wealth funds and sovereigns. It's a high quality customer with a strategic imperative to spend. That's not going to stop. So, the valuations aren't really that bad. They're really not. I'm deep down inside, I'm a value guy. Okay, so coming from me, it's really not that bad. There are pockets of excess, but happens in markets. Just got to pick and choose. I'm probably not going to go own quantum stocks, for example, right? We do these curations at Lumida Wealth. I hope you enjoy those. At Lumida Wealth is the handle, but we try to filter through the various podcasts. So too many, it's an information glut. Separate the signal from the noise. I use this very selfishly to stay focused on good signal, right? So, the main constraint is energy, and that's where we're focusing more of our time. We're closing out a Series A investment in a data center energy infrastructure company. I can't really share more about it at this point in time, but I don't think people are focused enough on the energy side of the data center equation. Obviously, people looked at uranium, they bid that up. A lot of stocks like Oklo, which have gone nuts. I wouldn't be looking at that at this point. But nuclear is going to take some time. But natural gas, I think, is the move. This category has pulled back recently, and it's now attractively priced again. Kinder Morgan reported earnings this morning. It dropped 4.7% despite growing double-digit year over year. They had a miss on expectations. I think those are interesting setups. The core business is actually growing, but there's a miss due to analysts being overly optimistic. So we're looking at that category. I think natural gas is a very interesting area to focus on. The turbine, the generator category, the midstream area, I think all of that is very interesting. We need more exposure there. I don't have that much exposure to it. I need more exposure there. Another friend at this dinner last night, I've known for a few years, he mentioned he's got exposure there, but it's not performing. I want to take the other side of that now. People are getting overly pessimistic there. So that category ran quite a bit. I talked about Shineri in April of 24, had one heck of a run, and its peer group did as well. And I remember it was December of last year. I was driving to the local grocery store. I always turn on Bloomberg to get a sense of what people are talking about. People were talking about natural gas all over. And I said, all right, maybe everyone's bought into this whole thesis. And then you had a 9-month sideways to go nowhere, mini correction consolidation in the category. This happens all the time, right? This happened in NVIDIA, which has posted double-digit earnings and revenue growth and beat and raised every quarter since the onset of GPT. But despite that, you can have these consolidations. And I think that's the next one. Financials, the next one to start setting up pretty soon. Financials, they've done extraordinarily well. Banks and regional banks and insurance companies. I think this is more evidence that you're not in a bubble. These names are cheap. I can find many names, not just one. So all that makes me bullish. Small caps we have the most exposure to. And, we just find many names that are well priced, growing, and have good technical entries and setups. So I think the last 2 weeks I've been kind of shouting about Goldilocks. And this is Goldilocks, and no one knows it's Goldilocks. And now you have S&P at all-time highs today. You would never guess. If you ask a typical person, they probably assume the market's like flat to down or something like that, or up 5% or something, right? But here we are. So let's see, what else can we chat about? I'll give you one idea. This is a name we bought 3 days ago. Okay, it's called GoGo. If you guys flown on a plane and gotten in-flight Wi-Fi, that's GoGo. So you pay the $8 on United Airlines or American. So this is an interesting business. We have about a 3% position size on this, to put it in perspective. It had a strong run and it's pulled back, and we think technically it's well positioned here. We like decent entry, although it was at $9 just 3 days ago, by the way. Now it's 9.77. So up 8% or so in a couple of days. So maybe you can find a better entry if you think the analysis is good. But this is part of our travel and leisure theme. So boomers are retiring. We're at peak retirement age for the workforce. They're spending on travel and leisure. That's just what Brian Moynihan said. You go to fly on a plane, you can see it's full. And by the way, you don't have to fly on a plane. You can look at the earnings reports of these airlines. People are traveling. So they're going to spend on Wi-Fi. I think it's an interesting sidelong bet in that category. It's a dominant market leader too. How much competition do they have? So going into Q4, you're going to have peak travel coming up. I think the timing is interesting for a number of reasons. But if I look at this real quick, I'm not trying to do a deep dive on this. I think the last super deep dive I did was Norwegian Cruise Lines back in June. We spent 35 to 45 minutes on one stock. And that's just the tip of the iceberg. Think about how much work you have to do just to get to the 45-minute synthesis. This I call a flyover, right? To do a deep dive would just take a lot of time. But there are a lot of angles to it. I recommend listening to that, the Norwegian Cruise Lines, because that one was top down, bottom up, fundamentals, technicals, the whole thing. Peer group analysis, Porter's 5 forces, product analysis. That's what you gotta do if you want to be a skillful investor. Okay. So I look at GoGo. I'll call your attention to the EPS numbers here. These are analyst expectations. Analysts are often wrong, by the way. Keep that in mind. I don't underwrite to what analyst expectations are, but I start there as an anchor and then try to figure out how much is this priced in and are the analysts overly optimistic or not. But just, you can see at the outset that if I put this on, like, say, an annual basis, right? We want to be investors, right? The long-term approach. I can see here that the EPS is set to inflect from 10 cents earnings per share to 30 cents, 55 to 82 in the next 3 years. So if the analysts are halfway right, if the analysts are just halfway right, this should do well because the earnings growth is set to increase significantly. I mean, 10 cents today to 30 cents next year this time. That's 200% incremental earnings. So you can't use Starlink in the plane. It's not gonna fly. No pun intended, right? So the bear case here, it's always good to look at the bear case, is that the trailing PE is very high. The forward PE is very cheap. So it looks cheap from a forward valuation, looks expensive from a trailing valuation. So the other part I like is they're actually making money, so they don't have to issue shares and dilute themselves with investors. That's good. That's important. But this is just one of many small caps that we look at in the market. And I could easily walk you through like 10 more. Easily, would not be hard. And when we see that thematic consistency, that gets us excited. Because when it's hard to find opportunities, then that gets us cautious. I don't see that now. So, it's hard to find a category that doesn't have a good story. I mean, even like the commercial real estate category, the interest rates are now sub 4%. So, they can start refinancing. We're at least halfway or 3/4 away through this commercial real estate digestion. The East Coast commercial real estate firms have recovered. I don't own these names, by the way. I'm just making an observation. I own maybe implicitly through the banks, actually, because the banks finance commercial real estate. But they're in a senior secured position, not in an equity position. They're doing, even many of them are doing pretend and extend, but it doesn't matter, right? It doesn't matter. So thank you, John. I appreciate this. Look, what we're going to do is this. Next month, we're launching a Lumida AI app in the Apple iStore. And it'll be available on your iPhone and Android. It won't have trading ability initially, but it'll have research ability. So it's a distillation of some of the core tools that we use. We have some pretty hardcore analytics, factor models, thematic research. Our AI will go read the front page of the Wall Street Journal, the Financial Times, American Banker, Defense News, Healthcare News, and then it creates our own front page news. So that'll be in the tool also. But one of the things I want to do is we can put the Lumida portfolio in the tool. You guys can see what we're looking at, what we own, maybe what's on our watch list. So that'll give you guys ideas. The problem with this is that we own dozens of positions. So if I give you an idea, it doesn't work out, people get upset. What you should own is a portfolio. Although I think our ideas are doing really well, fortunately, knock on wood, right? Then we talked about Bread Financial last time. That's done pretty well. We got Better Mortgage. We had a chat with Eric Jackson. That's done well. So far, so good. But markets will always humble you. They'll humble you, right? So you got to be, you want to make sure you're getting your timings very, good timings and good entries. But overall, I think S&P hit 7,000 plus by year end, driven by earnings growth. Positioning matters. Maybe Netflix is running to limits to growth. I don't own that name, but Meta, I think these guys are fine. Double-digit earnings growth, 25 times PE. The mortgage refinance thing was really probably the thematic bet of the year, I would say, right? Like these names and other names in mortgage have done extremely well. Probably the bet of the year, I would say, right? But what else? So here's another one. Here are things not to do. So over the last few months, we've seen an incredible IPO market. I think nearly 200 IPOs and dozens of SPACs. So in the beginning of the IPO market, I shared this before, deal quality is very, very high. The bankers are going out there, best deals. They take them out to T. Rowe Price, Wellington, and BlackRock. And then the IPO market gets activated if the deals do well. And they have done well. So CoreWeave was one of the first to go out this cycle. It went out like April 9th or something. Actually broke the IPO price from $40 to like mid-30s, and it went up to 130 or something. But there's a lot of IPOs, a lot of DATs. And so what happened is the narrative shifted from quality of the IPO to the fact that it's an IPO. People just want to get in IPOs now. It's like, what's the company? Oh, it's doing an IPO. Okay, how do I get involved? So, and there's been too much. It needs to be some digestion, and it breaks the attention of markets. Like the reason why digital assets hasn't taken off as much as people probably thought it would is because it's competing with other attention assets like the IPO market, like quantum stocks, for example, right? So I think from here on to the end of the year, I think themes that I think, again, like financials, I think a lot of themes will do well. Consumer discretionary stocks, I think, will do really well. Q4 retail sales is when there's a lot of retail sales activity. They'll report well. They have more cash in their bank account from mortgage refinance. Access to credit is strong and growing because there's so much money moving into private credit. Really, if you think about what we've seen over the last couple of months, right? Remember we had the whole Iran-Israel okay, this is the next shoe to drop. There's a lot of fear in the market from that. The matter resolved, stocks go to all-time highs. That was the market trying to separate you from your investments. Then you had, what else? You had 2 weeks ago, Trump-China trade war redo. And then you had a talk over the weekend. That was another time. Then you had government shutdown. All of these have been very shallow pullbacks, followed by all-time highs. And each time what happens is someone gets scared of the market, they sell, drive stock prices down, markets recover, right, to what the asset pricing would be. And then that cash is saying, gee, I'm offsides, I have to get back in. And that dynamic pushes markets higher and higher. That's the dynamic. I don't know if I explained that well, but hopefully that makes sense. So corrections create the fuel of a bull market. It's what we call the wall of worry. There's a thick wall of worry. And if you look around, things are actually getting better. People are living longer. GLP-1s are contributing to that. AI is driving productivity growth. Geopolitical risk is reducing around the world. Trump doesn't want to trade with China. China needs the US. There's more deregulation coming. The Federal Reserve is embracing digital assets. They use the word crypto. Fed Governor Waller earlier this week made comments that almost read like they're coming out of a fantasy novel. I mean, you can't make this stuff up. I mean, I read this and I'm like, huh? And this follows Fed Governor Bowman and the SEC Chair Paul Atkins. You've never seen a more constructive regulatory environment for innovation. Okay, so I'm going to try to pull up this comment. I'll share my screen. Okay, Fed Governor Bowman. Look at this quote. Okay, this is the Federal Reserve, which was part of Choke Point, 2.0, and made life difficult for people like Caitlin Long, who tried to access a Fed master account to move money and innovate around stablecoins. Right? We interviewed Caitlin a few months ago, ex-Morgan Stanley executive. She knows what she's doing. So I call this post Fed Bear Hugs Crypto. And look at this. This is a paragraph from a speech. It's worth noting that these firms engaged in these activities include banks, asset managers, retail payment firms, technology companies, as well as crypto-native fintechs. This is an acknowledgement that distributed ledgers and crypto assets are no longer on the fringes, but increasingly are woven into the fabric of the payment and financial systems. Okay, they go on. You can't have a better speech, right? You can't have a better speech, really. So, yeah, it's really extraordinary times, and I think you should be optimistic. Okay. Areas I would want to avoid are areas like venture capital. Let me play this clip. This is by the CEO of Sequoia. He's a thoughtful and brilliant individual. Sequoia Heritage, incidentally, was one of the investors in QXO. It's a deal that Lumida invested in summer of last year. It was quite an illustrious cap table. It was Sequoia, Duke University, the Walton family, 3G Capital, and then Lumida. I'm sure everyone on the cap table was like, who the hell are these guys? That took a lot of hustle, but really proud of that deal. So let me share my screen here and see what Roloff has to say. And I agree with his statement. I thought it was right on the mark. Let's play this.
With the capital asset pricing model, and people figured out that there's this. I don't think venture is an asset class.
Why not?
It doesn't support the numbers. So there was a lot of analysis back in the 1970s and 80s with the capital asset pricing model, and people figured out that there's this asset class that supposedly has uncorrelated returns, and a bunch of asset managers deem that they need to invest a certain percentage of their endowment or foundation or pension fund into this thing called venture capital. If you look at the data, there are basically 20 companies per year on average over the last 20, 30 years that have ended up being worth, in realized exits, $1 billion or more. Just 20 companies. Despite a lot more money plowing into venture capital, we haven't seen a material change in the number of companies that are outcomes that are that large. And I think part of that is that there's a lot more talent than really interesting ideas or interesting companies to be built. And I think we're spreading a lot of that talent thin right now, similar to what happened in 1999, by the way.
Yeah.
So when you look at the data, the amount of money going into venture capital right now in America is in the order of $250 billion a year. And the numbers, these are all estimates. Let's just say it's $250 billion a year.
Need a lot of exits.
Well, let's just do some very simple arithmetic for a second. $250 billion going in every single year. If you assume that the firms generate 12% IRRs net of fees and carry, which isn't that great, by the way. I mean, over the last 3 or 4 years, the NASDAQ has compounded at 16, 17%.
Right.
Let's just say 12%, not spectacular. Basically just average performance. You'd need a 3.7x roughly.
On 10 years.
On a 7-year exit horizon. So I'm being a little bit aggressive. I mean, maybe it won't even be that good. So 3.7x on 250 billion. That approximates to $1 trillion a year.
Coming out.
By the way, that means, and that's what the investors own. So let's say that the investors own 2/3 of the company, to make the arithmetic simple. That's 1.5 trillion annually in company exit value.
Yes.
Just think about that for a second.
Where's that coming from?
Well, Figma's worth what?
It's a lot, but
40-ish billion. I mean, that's.
Let's say it's worth 0.03 trillion. So, if you start thinking in trillions, and Figma gets you 0.03 trillion,
you need 30, 40, 50 Figmas every year.
That's wild. That's wild. Did you guys know that? To justify the return on venture capital, you need 30 to 40 Figmas per year. By the way, he quoted Figma as a 40 billion valuation. Guess what it has now? It's dropped. It is a valuation of 26 billion. 26 billion. It's like an IPO pop that burst, right? So I think there's going to be softness in the IPO market, animal spirits for a bit. I think digital assets can actually run, but these are like subtle distinctions, and you have to be on the ball. So, we'll see what happens when, say, Bitcoin gets 125K. Can it get through there, or these OG whales just sell, which has been happening. But, so point of that is, if you look at what are the best assets to invest in around the world, I don't think alternative assets are actually really the move. Like, I don't think it's private credit. If you earn 10% of private credit funding, half of it goes away in taxes due to federal and state, you're at 5%. Then 3% you lose to inflation, you got 2% left. If you happen to be in a high income bracket in New York City, depending on the mayoral election, that goes to zero. Okay. You're just floating, you're treading water. You need real earnings growth. So I think that's public equities. What's the alternative? That's another way to think about the bull case. What is the alternative? Tina, there is no alternative, right? So I'm going to share with you just a few other highlights. This is like a peek inside to Lumida research. And let's see if I can find this. Actually, I haven't been planning to share this, but maybe, why not, if I can find this quickly. If you have any questions, by the way, in the meantime, maybe throw them in there. Okay, here's one. So defense stocks reported a few days ago. We don't have that much exposure to defense. I like some of the opportunities there. We're looking at a private company that's doing FSD for drones. Too early to say. It's too early to say whether we'll invest in it or not. I don't want to highlight the name, but if we do it, it'll be on lumidadeals.com. So if you're interested, you can take a look at that. But yeah, FSD for drones. I think that makes a lot of sense. We're moving to drone-based warfare, not big platforms that are easy targets for hypersonic missiles. So I think defense is an interesting area. We've been talking about Anduril a lot. Anduril's expensive now. Anduril's like $60 billion market cap. Defense contractors worth $200 billion. These defense contractors, I think they're going through some technical innovation and disruption. But take a look at this. So, Lockheed Martin will continue to see broad support for national defense priorities. Raytheon. These aren't necessarily names we know. In fact, we don't know any of these names, by the way. I'm just looking for thematic read-throughs. Just looking for what's happening. What are the big trends? Okay. Backlogs are growing, et cetera, et cetera. So here's on the energy side. So these are highlights that our analysts generate after companies report earnings. So I have this for every day of the week, and we organize it by theme, because generally companies will try to report around similar times. This is energy companies now, commodity prices and global demand outlook. Kinder Morgan. Take a look at this comment from the CEO of Kinder Morgan. It's a natural gas midstream pipeline company. So they transport the natural gas from the drilling location to a point of distribution. Pipelines. They're bet on the volume of natural gas, which I believe will be going up because you need energy for data centers, and also Europe needs more natural gas. So I'm not going to get it from Russia. That's part of the Trump trade deal with Europe. Okay. Spot natural gas is highly volatile. It's a commodity. It's all over the place, incredibly volatile. Let me show you natural gas real quick here. Okay. This is natural gas. Highly volatile, right? Incredibly volatile. At $8, $9 down to $3, right? But midstream is different. The growth is indexed to volume, and it's a cheap form of energy, and it combusts relatively cleanly, unlike oil. So Elon Musk's data center in Memphis, Tennessee, that powers Grok, uses nat gas energy. Isn't that amazing? So these turbines and generators that take the nat gas and they generate electricity. I think you're going to see a lot more of that. And there are other companies out there doing this that build the generators, build the turbines. So we track those stocks. We wait for them to go on sale, then we go buy them. Kind of simple, right? The market knows these companies though, so they've run up, and we're looking for good entry points. But going back to energy, so this is what he says. Says, quote, there will clearly be huge additional demand for electricity, primarily to serve AI data centers. The combination of AI-driven electricity needs and LNG, that's liquid natural gas, feed gas expansion ensures a massive and growing market for natural gas in the years and decades ahead. Okay, I won't walk through the rest of this, but those are some of the highlights that we see in transcripts. Okay, the alpha is in the transcripts. That's what you want to do. Study the transcripts to develop your own point of view. If you're relying on a third party, I'm a third party, by the way. I think we're pretty good at what they do, but what we do, I'm trying to be transparent here, right? Best I can. But if you develop your own views and you're early to developing the view, then I think you're closer to generating alpha versus following onto a late thesis. Okay. So what we do is this, by the way, we have this, this AI tool. This is our internal tool, but we can run different themes like natural gas, midstream energy, and it'll do some analysis for us, right? So you can run bull bear cases on a bunch of them, and just my AI, I can start asking the questions and say, which of these should I buy? I ask more deliberate questions than that, by the way, but I'm just trying to make it simple. And it has a write-up, has a bull case, has a bear case. So this is what we're going to make available on our Lumida app, which will be around in about 30 days. Here's the website, by the way, lumidaai.com. We have a wait list there, so check it out. So that's something you can use in your investment process, coming very soon. I'm testing this internally. You see it, it's live, it's working here. We're just putting it into a mobile platform. Okay, so one name I'm stalking there is Kinder Morgan. Okay, so Kinder Morgan is one of the more expensive names here. The other name is MPLX, which is cheaper, has a bit more relative strength, but KMI seemed like is one of the leaders in the category. But if you look at this, Kinder Morgan ran up from February 24. This is along with the rise of GPT and these data center boom. Okay, and then it went nowhere for about 9 months. And now they reported earnings. It's dropped here. Okay, but if you actually look at the earnings, this is an example of how we do some analysis. Okay, we're doing this analysis live as we speak. But when I see the price drop and I see, well, the EPS is actually up 16%, and the pipeline is growing, then I say, gee, maybe the market put this asset on sale for me. Maybe that's an interesting opportunity. Just like when the market sold off the regional banks Thursday of last week on concerns about credit risk due to the frauds of Tricolor and Canton and First Brands, right? And I had a live stream. I said, yes, this is tempest in a teapot. It's not systematic credit risk. Time to go buy banks, right? So the market will create these opportunities. I think you take advantage of those. So let me show you NVIDIA. Okay, so NVIDIA's done beat and raises for a long time. Long time, okay? Since the onset of GPT. And if you, despite that, the stock, after, I use the word over position. It means like too many people own it. It's too much enthusiasm around it. Then what happens is the stock just goes nowhere for a bit. And that's what happened with NVIDIA. Okay, so big run up here. This is like the chat GPT moment. Strong rally. And then in June 14th, this was, by the way, after the May earnings of 24, which were blockbuster. Everyone went into like a fever pitch mode, just buying NVIDIA stock. It rallied. Then it's top ticked the market on June 14th. That's the day Kathy Wood bought NVIDIA. I wrote a post about it on that day. I said she top ticked the market. Kind of funny, tongue-in-cheek humor. But, NVIDIA went nowhere for about a year, okay? 9 months, and actually corrected, and the price dropped double digit. Now it's back. Now it's healthy again. Good trend. So the point is, you can have companies that are growing, like from an owner perspective, the earnings are going up, the revenue is going up, the story is good, the customer backlog is good, but the price isn't behaving the way you want it to. That can happen simply because of just over positioning. Okay, so eventually the markets clear these indigestions, they capitulate, and look at like restaurants. Remember like Chipotle. Chipotle is a popular stock, or Kava, very popular stock. They're in bear markets now. But that will clear out at some point, and probably soon. Those all topped in May of last year. So, and then they'll be back to bull market status again. What's happening in this market, different sectors are taking turns doing corrections. Healthcare just went through that. Remember United Health? In May, everyone's talking about United Health in the front page of the Wall Street Journal. Anyone that was scared about owning United Health sold it at that point in time. Okay. And United Health is up like 30% from the lows, for example. This is United Health. Okay. So it's at 360. It was at 300. That's 20% up from 300. And it got as low as 240. You don't have to, nail these bottoms, but once they start to settle, there are opportunities there. Yeah, so anyway, that's United Health. But what I see is a market with different corrections in different areas, which create opportunities. When everything goes up together at the same time and everything's overpriced, that's when you should be worried. And everyone feels euphoric and it's palpable. And everyone sees Goldilocks coming or here. We had a bit of that after the Trump inauguration. Remember the speech with the spaceships going in the air and rockets, and that's when you had a bit of euphoria, actually, mini euphoria. We don't have that now. I don't see it. People are despondent. So this is a great question. I love questions, folks. Keep them coming. Thank you. Do you think there are software companies that are overlooked right now, but will benefit as businesses start to experiment with implementing LLMs? Yeah. So look, software stocks have generally been in a go nowhere category, generally been in a bear market. AI is coming to disrupt software. I wouldn't want to be owning Salesforce, for example. Look at Adobe getting destroyed by Midjourney and GPT and Sora, right? The thing is actually cheap now. It's actually like, I wouldn't want to be too bearish on Adobe now. I mean, it's like 4 PE. I don't own it, but it's like the kind of thing I'm supposed to look at least, right? And maybe things have gone too far, right? It's important to be mentally flexible. 15 times 4 PE is Adobe. It looks like a little double bottom there. I don't know. Could be interesting. But the other things I can own where that's worth analyzing. But yeah, are there names in software? Yes, there are. There are. So I don't own these names, to be clear, but I like these companies. And if they sell off, I would buy them at the right price. So a lot of what we do is we track what we see as great businesses and different themes. We're waiting the market to put them on sale. I want to buy them. If the theme is constructive and working, I want to own them. Apollo and private credit was a great theme, if you remember in 2024. We don't own that now. That theme's in a bear market. It'll come back though. Just like we talked about how these excesses get worked off. I talked about NVIDIA as an example, Kinder Morgan and NatGas as an example. Those themes will come back to life and other themes will go on the bench. That's what happens. So two companies, like, again, like, I don't think the timing is exactly right now. So, but I'm tracking them. One is ESTC, Elastic. Okay. So ESTC is like a 10 billion-ish market cap company. If you're a software engineer or developer, you probably have heard of this company. But they enable oh boy, like just the company description is a bunch of jargon and words here, but it offers elastic observability, and you can analyze and search petabytes of structured and unstructured data. So I think the demand for data, and you're going to see more and more data generation, terabytes of data, due to the rise of AI, right? We already haven't seen the rise of data. Okay, you can play it with Western Digital and other companies, but I think that's going to keep happening. But searching that data, generate insight will matter because AI needs memory. So it needs HBM memory, but it also needs a way to extract information. That's a name we're stalking. Don't own it. We'll wait. We'll be patient. Just wait. That's all I do. Wait. Every week we look at every single theme. We just look at each theme. Is the theme ready or not? Should we gotta go and buy the theme or not? That probably is like 40% of value creation, by the way. Significant value creation from that. You know, there are investors where they're just specialists. They only do software. They only do banks. I think that's a wrong move because sometimes themes are in and out of fashion. And the great companies in those themes generally don't change. Not as if the management team's turning over or their product leadership ebbs and flows. So if you understand what themes are working, you can position into them and avoid them when they're overbought and expensive, rotate, I think you can do well. That's a core part of what we do, and I try to have like a dozen themes. So I'm diversifying across themes that I think will make money because diversification works, but you don't have to own everything for the sake of owning them. You have to own ideas that you believe in, right? That have good earnings growth. So that is one. You know, another company I think is interesting, so ridiculously expensive, but it's a cool company. I don't own it though. It's like Datadog. I think Datadog is an interesting company too, but benefit from the rise. Again, I don't own those. I'm just, answering this question. So overlook companies in software, maybe Adobe, I'll look at it this weekend. We'll take a look at it. Again, I don't think it's a good buy today where we stand today. Like entries matter also. So, I think the move to make actually is more like financials and insurance names. And one of the reasons I'll share that is this chart here. I'm going to show you the growth to value chart. This is a good little barometer that I like to look at least monthly. And I'm going to show this chart. If you have fear of heights, you might want to take a deep breath here, okay? So this is growth stocks in blue line and red stocks, S&P growth divided by value, okay? Yeah, if you have fear of heights, you're going to feel some there, right? This is a growth stocks, like high beta names, have had an incredible rally, and value stocks have been left behind. So I think this will have some mean reversion. So, the S&P 500 is 50% growth, 50% value. I think you want to tilt 60% value, 40% growth, or maybe you do that at the end of the year because Q4 things can get nutty around growth stocks. Okay, so that's what I would be doing. So my largest thematic exposure right now is financials. Okay, I'll show you some examples. Here's one. This is a name. This is a name where maybe next week you'll get a good entry. Maybe next week. Looks like it's, give it a few days. This is Kingstone Companies. It's a 7.5 PE ratio value. It's gone up 50% a year, momentum. And they provide insurance in the New York market where they filled in a gap from two other property and casualty insurance companies exiting. So they cover damages on hurricane risk and all the rest. They're growing earnings double-digit rate. They're a niche leader. I like niches. I don't mind niches as long as it's a leader. They have good management. So that's an interesting name. But there are a lot of names in insurance I find interesting. So this is on the more boring side, but boring can be good. And the entry here looks pretty damn good, actually. I'm glad we stumbled on this topic. You look at like Allstate. Right? Allstate's probably perfectly set up, actually. This is like an excellent entry point, I would say. I'm going to show this on my screen here, but I'll show you what I'm looking at. Okay. So everyone knows Allstate, right? Leading insurance company. This company is not going to go away. It's not going to get disrupted by AI, but it's got it's on the lower end of this range, and the price free cash flow is sick. This is just bonkers cheap. The free cash flow is 17%. Now, is that going to make 30% a year? I don't know. Maybe it does. Who knows? You'd be surprised. Sometimes they can. Some they can do well. But the risk reward on that is very attractive. My reward to risk ratio is very attractive. It's definitely a store of value, right? Look, there's always principal risk, right? Trade war happens, whatever. There's risk there. But the reward is much better than the risk. You can see that, right? 16% free cash flow yield, like that. For a Mag 7 company, it's closer to like 2%, just put that in perspective. Okay. So, but there are others out there that have insurance land. It's just, I see these valuations and earnings growth together, and that gets me excited. Okay. Let me show you. So Kingstone, that one I mentioned, the free cash flow is like 30%. It's like, what? Why don't I raise a private equity fund and just acquire this company? 32% free cash flow yield. How about the index, KBWP? Let's take a look at this one. The index has a 15% free cash flow yield. And it's only been cheaper during COVID, meaning it's only had more yields during COVID, right? I mean, it's been cheaper maybe during the trade war. So it's not expensive. These insurance companies aren't going to go away. I mean, insurance is regulated. AI is not going to take them out, right? So those are interesting names. They're interesting ideas, right? Who's talking about that stuff? So I like that. I like that. I'll tell you this, the Venn diagram of investors that can own momentum, digital assets, free cash flow and buybacks, and value stocks with earnings growth is maybe like one. That's me. Okay, that's it. But I think you have to be open-minded and flexible. There are different ways to invest and make money. And if you can get an edge in a different strategy and put them into a portfolio that fits well together, then I think you're onto something. Okay. So what else? How do you make your living? No, Lumida is an SEC registered investment advisor. We're a wealth manager. We allocate capital for our clients. We get them into public equities, alternative investments. We use technology to do that. We have 24 people now. It's pretty cool. We're building out a nice studio. If you're ever in Wayne, New Jersey, we're just above the Whole Foods there. Stop by. Building a studio so we can do live earnings call analysis. When NVIDIA reports, it'll be like Sports Center and talk about real-time earnings transcripts. We'll have our AI tools spit out the results. Maybe get an avatar there that interprets it. We can talk to the avatar. This is where we're going. This is the direction of travel for us. You'll see that in the next 6 months. It takes time to build, but we're moving in that direction. All right, good stuff. Well, hey, thanks for the time. Really appreciate it. If you're not on the new newsletter, make sure you subscribe to Lumida Ledger newsletter. I write it myself with support from our analyst team. We drop it every Sunday at 11 a.m. Eastern time. There's a lot of ground we cover, including plenty of ground we have no time to talk about here. There's so much happening in the world. But if you stay on the right trends and the right themes, I think you're in good shape. So main message is, don't be too down. I think you should be optimistic. And one of the best times to be optimistic when you're in Goldilocks and no one knows you're in Goldilocks. Okay, that's the main message. All right, have a wonderful weekend now. Take care, folks. Be well.